Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin versus the US dollar currency index, or DXY. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. Now, as we've discussed this year at length, Bitcoin is just simply in a bear market. And one of the reasons for that, of course, you could argue, is the tightening of monetary policy by the Federal Reserve. By draining liquidity from our system, they are making it very difficult for risk assets to see sustained rallies. And while we have seen some rallies, all of them have simply turned into nothing more than a lower high. Okay? So again, as the Fed drains liquidity from the system, you generally will see these risk assets continue to slowly bleed. I've put out this, sort of metaphor before. Imagine we're all standing around a swimming pool and the Federal Reserve is draining the water from the bottom of the pool, right? They've pulled the plug out and the water's slowly going down. Well, as the water goes down, the liquidity, right, in terms of going back to the financial conditions, right, liquidity gets drained out of our system. But we also know that Bitcoin thrives on excess liquidity. So when that liquidity is removed, it tends to not be good for risk assets like Bitcoin and equities. However, because there's a lot of people standing around the swimming pool, investors like maybe you and me, occasionally these investors will throw their money into the swimming pool. They'll throw some liquidity in. And if enough investors throw in their cup of water, or their money at the same time, you can get a counter trend rally, right? You can get a bear market rally that will take us back up for a while. So in the short term, the water can temporarily rise, but the Fed's still draining the pool, right? So the water level may go up in the short term, but the liquidity is still being drained nevertheless. So the general expectation is that while you could see counter trend rallies, doesn't really change the general direction of where the liquidity is heading. So when you think about that, it really does help explain these counter trend rallies. Of course, there's always going to be the buy the dip crowd, right? And when there's enough of these people at the same time, we can get one of these bear market rallies. But one of the things we've also discussed at length is the US dollar currency index. And because of this rate hiking cycle by the Federal Reserve, this has contributed to this parabolic rally by the US dollar currency index. Okay. Now, we've followed the US dollar currency index for a long time. If you remember, in fact, I have some videos from early 2021 where we warned about the risk here of the dollar finding a bottom, the same place that it found one in 2018. And this is why I remained very skeptical on these 100K Bitcoin price predictions in 2021, because the dollar was finally starting to show some strength, and it was slowly starting to turn back around. Now, what's interesting is we can sort of map out some of these important levels over the last several years, and what I really want to hold in on is the fact that the dollar has pulled back significantly, but Bitcoin's price still remains fairly low. Okay, so we're going to talk about that. One of the things that you'll notice, and if you actually go look at the U.S. dollar currency index, I actually have a chart of it, but let me go find that really quick. So if we go look at the U.S. dollar currency index, so this is Bitcoin versus DXY. This is the dollar color-coded by this risk metric I have for Bitcoin. You can see that as the dollar goes up, Bitcoin risk tends to go down. So it goes from red to blue, right? So red is high risk for Bitcoin, blue is lower risk for Bitcoin, right? High risk, low risk, high risk, low risk, et cetera, et cetera, et cetera. So you normally see that. However, on this move down so far, we haven't really seen Bitcoin go on any rallies, right? In fact, the opposite occurred, and Bitcoin ended up going down quite a bit after the meltdown that FTX had. So first of all, you should realize that no matter what happens in other markets, there's always going to be this sort of like idiosyncratic risk of any individual asset class, that there's always going to be a risk on no matter what. And just because something happens that would normally signal that market to move, you do have the idiosyncratic risk of that asset class that could still lead it to behave in ways that it wouldn't normally behave. But for me, as I've said, as long as the Federal Reserve is going through this rate hiking cycle, and as long as we're still seeing a recession sort of looming on the horizon, then the general expectation is that risk assets will continue to remain under quite a bit of pressure. But one of the things, though, I think that we can look at with the US dollar currency index and seeing this massive pullback by it in the short term is to look at how important some of these levels are in the context of history. Okay, so the first thing you can actually look at is this level right here. And this was where we peaked at in March of 2020. So that is an area that I at least find somewhat interesting, because if we do go down to that level, I would expect the US dollar to find some level of support at that area. Furthermore, if you continue this out, you can see that there also tends to be a local top back in 2017 at around this same area. So I would imagine that this sort of range right here, the 103.8 all the way down to the 103 or 103.1 or so, I would imagine that this range should offer some level of support if we were to reach it, right? Of course, this is a big if, but if we were to reach it. Now, you might wonder, though, what does history tell us about some of these levels? But before we do that, what we need to do is we need to go over here and look at inflation and find periods where we also had high inflation. You may notice that we also had a surge of inflation in the 70s and in the 80s, early 80s. You also notice that we had recessions during those periods of high inflation because the Federal Reserve was raising interest rates. Okay? Now, this peak on inflation here was in the early 80s. Let's go see what the US dollar currency index was doing back then in the early 80s. And what I want to do is take this top here and go all the way across. And actually, you know what we might do? Instead of doing that, why don't we take a parallel channel and then just go all the way across, okay? And we're going to take it basically from this sort of high here and this high right here, and we're going to extend it, okay? We're just going to extend it all the way back to the 1980s. Okay? So that's what we're going to do. And just to get this as accurate as possible, let me go ahead and remove the green one. And if we pull it down to this peak right here. So this peak peaked at around 102.979, so just below that 103 level. Okay? And we could draw maybe a separate box in here to show this top as well that, came in 2017. And we'll also simply extend that across all the way to the 1980s. Okay? So that's what we're going to do. Extend it all the way across. Now, what you may notice, and I guess this parallel channel is not exactly horizontal. Perhaps now it is. Yeah, I just had to make it horizontal. So what you may notice with this trend is that something very similar happened in the 80s. We had a peak here at around 114 to 115, right? And if we get the exact number, it was 114.778 was the highest it went. You go back to the 80s, the early 80s. We also had a very similar type of move where the peak was 114.880. What you'll also notice, and again, this was coming out of a period of high inflation, hopefully like we are right now. What you may notice is that after the dollar peaked here, we had a massive pullback. And that pullback started in August of 1981, and it lasted until November of 1981. So to get an exact range on that number of weeks, you can see that it lasted about 16 weeks. A 16-week pullback by the US dollar currency index starting in August of 1981. However, after that, it surged back up to put in a new high about 18 weeks later. It then came back down and then blasted off all the way up to the 160s. Now, I'm not of the general expectation that the dollar is about to go to the 160s. And furthermore, if you look at this path by the US dollar currency index from this level here in November of 1981, it did not hit this peak until March of 1985. So you're talking about, over 3 years. This is not something that would happen in any short time frame if it's going to happen at all. And I sincerely doubt that the dollar is at least going to be making up into this range in the next year or anything like that. But what you may notice is that you had this period right here in the 80s, right, in the 1980s. And if you look at the 1980s, again, we had high inflation, right? And we also know the Fed was going through a rate hiking cycle, right? So the 1980s, you can see the Fed was raising interest rates all the way through December of 1980 is when you can see they finally started to slow it down, right? December of 1980. Go back to the dollar. The dollar bottomed, hit this local bottom in December of 1981. And what's interesting is that after it bottomed, right, a year after the Fed stopped raising rates, it still went up. So it doesn't only go up, of course, when the Fed is raising rates, because it went up in 1982, and 1983, and 1984, and 1985. So then why was it continuing to go up, right? Why was it continuing to go up? Well, you also have to think about recessions, right? When you get a recession, you're also generally going to have people flocking to risk off, right? And wanting to go to the relative safety of the US dollar just because they are not as aggressive with accumulating risk assets during that time. So when you look at it like this, you can see that it took about 18 weeks for it to get to that low at around just below 103. And then if you scroll over to today, what you'll notice, remember that pullback back then started in August of 1981. This one here started in September of 2022. If it were to take 16 weeks to get to this sort of same low that it went to back then, which is right below 103, it would get there by the middle of January. Okay, so the middle of January, if it were to repeat the same type of move that it did back then. However, if it were to continue along that fashion, it would then come back up to new highs sometime in the middle of next year. So, I know a lot of people are looking at the US dollar and thinking that it's just completely done and that it's just going to go back down. But history would at least caution us against that stance. I'm not saying it's going to play out the exact same way as it did over here. Honestly, there's a good chance that it won't. There's also a chance it could play out like something like this, where we do go back up, and maybe we put in a slightly higher high, but then we come back down, and then we go back up and then put in a lower high, and then we sort of finally roll back over and then go down. So there's also that chance of happening too. But what it shows is whether you look at what happened over here during the dot-com crash, or if you look at what happened over here during the period of high inflation where Volcker sent us into two very short recessions, back-to-back recessions, sort of get inflation back down, we still had surges in the US dollar currency index even after inflation was heading back down, right? The dollar was going up through 1985, but remember, inflation, which is this orange line, let me hide the interest rate. Inflation peaked in 1980, and by 1985, inflation was well back under relative control, right? Only a few percent or so. But the dollar continued to go up, even though inflation was coming back down. And I mean, of course, there's a lot of nuances to this as well. It's not always just about inflation and whatnot. But when you look at this chart, it would strongly caution you I think, to assume that the dollar is done. Why? If you look at the spread on the Treasury yield curve, you will notice that we are looking at a fairly deep inversion. History shows us that once we get these inversions, similar to what we're seeing today, we go into a recession afterwards. Because the Federal Reserve, they raise interest rates high enough to put pressure on a lot of businesses. These businesses have to lay off their workers. The unemployment rate goes up, and we go into a recession. One of the good things about recessions are that it has a way of bringing the inflation level down. Okay, so if you were to look at just simply the inflation level again, which is the orange line, you'll notice that in these recessions that we get, these gray shaded regions, they're able to help bring inflation back down, which is what the Federal Reserve is trying to achieve. Of course, the negative aspect of recessions are that a lot of people lose their job, which is not something I think that any of us really want to see, but it's just something that happens and it's part of the business cycle. So when you go look at the US dollar currency index, and if you're scratching your head as to why is Bitcoin's valuation still well below 20K, we're still sitting at $17,000. You look at this, you say, well, normally when the dollar goes down, Bitcoin is going up, right? I mean, this was the 2017 bull market by Bitcoin because you saw the dollar going down. This was the 2020 bull market by Bitcoin when the dollar was going down. The dollar is going down right now, but we're not getting a bull market in Bitcoin, and I wouldn't expect us to right now. So before you sound the victory bells on the US dollar currency index's rally being completely over, just remember that if you had assumed that similar pullbacks in history also immediately resulted in the dollar's rally being over with, you would have been sorely disappointed, because both during a period of high inflation in the 1980s and also during the dot-com crash that we did have a pretty deep recession, you'll notice that the dollar was not done just after it had that first initial spike up. It came back down for a while, and then it shot back up. Okay? So I think this is an important consideration to keep in mind. And if it were to play out in a very similar fashion, then I would expect sometime early next year, if it hasn't already, to see the dollar at least start to go back up, and then figure out what it's going to do from there. It's not all doom and gloom. I know a lot of you might think about this and think like, oh well, this absolutely sucks, right? But one thing to consider, just to maybe see some type of light here at the end of the tunnel, if you compare the S&P 500, if you put the S&P 500 on this chart and you go over to a logarithmic scale, you'll notice that during this phase over here, right, during the early 1980s, the stock market was going down and down and down and down and down, and it bottomed here. So it bottomed after the dollar broke out of this range, right? You might think, wow, so you're telling me that the dollar rallied and the stock market rallied. Yes. But it wasn't until the dollar came back up and then broke out. So one thing to keep in mind is that just because the dollar has acted in a very specific way over the last decade with regards to risk assets does not mean it's going to always act like that. If the dollar were to surge back up in early 2023, I imagine you would see equities take a pretty big hit. I imagine you would see cryptocurrencies take a pretty big hit. So like if it did something like this, right? Let me draw a path in here. So if the dollar came down and then came back up in 2023, like something like this, and we got to this level and then sort of bounced around for a while and then broke out to the upside, you might assume that at this point the dollar would mean that risk assets are done for a while. History shows us, again, coming out of a period of high inflation, that if something like this were to happen, this part could certainly correspond to new lows on equities and cryptocurrencies, but perhaps the dollar could continue its rally and it not necessarily continue to point to new lows for these risk assets. So I would encourage people to have an open mind about some of these trends and correlations that you've come to know very well. One of them being, while the dollar goes down, risk assets go up. That's not always true. In the same way, if the dollar goes up, like it did over here and went on this massive bull run, it actually also corresponded to a time when the S&P 500 went on a fairly crazy bull run, right? From 1982 until 1987, and then we had a pretty big pullback, and then we just simply continued on. So that is another way to at least look at the market. And so, really what I want to do here is just spend, the reason I made this video is because I just want people to look at the US dollar currency index in a different way than perhaps you're used to. And to also not just sort of immediately assume that just because it's had this pullback that the rally is over. We could easily see a bounce in 2023 where it comes back up. And I think probably the biggest evidence for that potential bounce is the inversion of the yield curve and the spreads on some of these popular treasuries. The 10-month or the 10-year and the 3-month shows an inversion. Typically means we go into a recession. The stock market usually bottoms during the recession. There was one time it bottomed after it in the last 100 years, and that was actually during the dot-com crash. Normally it bottoms during the recession though, and when you get that bottom, you'll typically see a flight to risk off. And so if we do see that in 2023, if we see that flight to risk off, once again, that could send the dollar back up, right? That flight to risk off could send the dollar back up, send equities back down. Perhaps equities will at some point next year find some type of generational low that we can then build off of going into another bull run. Hopefully you guys find this information valuable. If you do, make sure you subscribe to the channel, give the video a thumbs up, and again, check out Into the Cryptoverse Premium at intothe.cryptoverse.com. Thank you guys for tuning in, subscribe, and I'll see you next time. Bye.